Hi, this is Jim Bell, founder and Chief Investment Officer of Bell Investment Advisors. I want to welcome you today to our investment committee update. The topics we're covering today are interest rates, tariffs, and economic growth. You should be able to see a chat box on your screen. We encourage you to enter questions, which we will try to answer live. If we don't get to your question, we will get to it after the webinar, and a professional will definitely speak to you about your inquiry. There's a lot of information packed into this presentation. If you would like to get a copy of the slides, either by PDF or hard copy, just let us know at info@bellinvest.com. We have lots of ways to contact us that's at the end of this presentation. If you're having any audio or visual problems, please call our number at 800-700-0089. I'm happy to announce that I'm joined today by one of our newest colleagues, Ryan Kelley. He is a chartered financial analyst, and he has 9 years of experience as a portfolio manager. He's worked as an investment analyst, and Ryan has a passion for learning different investment philosophies. So welcome, Ryan. Very happy that we are working together on this presentation.
Thanks for the introduction, Jim, and it's a pleasure to be here.
Okay, let's get started. As I said, we've got a lot of ground to cover. The overview is very simple: interest rates, tariffs, and economic growth. I'm going to start by talking about the two sides of interest rate cuts. I think most of us would have the attitude that when interest rates go down, it's a stimulus for the economy. It's a positive event. It does help us as individuals and businesses to borrow money more cheaply, hire more workers. Individuals can refinance their mortgages, which gives them more cash flow for consumer spending. So it's typically a very positive view of the situation, and I'm sure you're all aware of there's much press about the Federal Reserve and how it is certainly approaching or hinting strongly that instead of raising rates going forward as they have for 9 times in a row, we could be looking at some interest rate cuts. Presently, the federal funds rate is been set at a range by the Fed between 2.25% and 2.5%. The Fed does have the authority to set this rate. The Fed's funds rate is really refers to what U.S. banks can loan to each other at what interest rates for short-term loans, for overnight loans. Banks have to follow regulations about how much liquidity they have and capital and so forth. So they do cooperate with each other by loaning and borrowing money. A big event presently, I believe it closed above 2% today, but the U.S. Treasury note did dip below 2% very recently in the last few days. That's a big deal. It's unusual for a 10-year Treasury to trade below the Fed's fund rate or overnight rate. This highlights a disconnect between the fixed income market and the world of the Fed, which is, I believe, will be remedied soon. As I've been saying, when the Fed cuts interest rates, as it presumably will, there's not just one potential reaction. Though many may see a rate cut as a positive stimulus, the other side of the coin is the Federal Reserve has the greatest amount of resources for studying not only the U.S. economy, but the global marketplace. So when the Fed cuts interest rates, many investors often will react in a negative way, that they must know something really bad about the economy especially if they're cutting rates with our unemployment rate at 50-year lows and inflation in a low range below the Fed's target of 2% for inflation. This negative reaction can cause investors to flee the stock market, drive stock prices down. Here at Bell, we believe the Fed cut, which is likely to come in July, not guaranteed, but there's a likelihood, will be viewed with a majority of people reacting to it as a positive stimulus, and the stock market will be buoyed by such a cut. I'm going to turn this over to Ryan now to talk about the bond market.
Great, thank you, Jim. So as Jim mentioned, the 10-year Treasury recently closed below 2%. I believe today it's slightly recovered, but still around 2% or so. It wasn't that long ago, back in November, it was about 3.25%. So that's a pretty decent drop in not a lot of time. Since bond prices move inversely to interest rates, returns for fixed income investments have generally been pretty positive across the board. If you think about what the S&P 500 is as a sort of core benchmark for stock investors, the bond market version of that is the Barclays US Aggregate Bond Market Index. It has returned almost 6% year to date, which is a pretty healthy return for fixed income. On the following page, you'll see the 3-year trailing rolling returns for the same index. And I just have this up here to illustrate just how much of a benefit that having bonds in your portfolio can provide. I actually had to go back to 1981 to find a 3-year time period where this index had delivered a negative rate of return. So that's pretty impressive and just shows some of the benefits and stability that bonds can provide in a portfolio. As far as what, and I mentioned bond market, the bond investments have been positive across the board. What has done the best? Well, it's pretty simple. The longer your maturity generally has done better than short, and also the more exposure you've had to credit risk, so corporate bonds versus, or high yield bonds versus say treasuries. So there's an index which is called the Bloomberg Barclays Long-Term Corporate Bond Index. It's returned a whopping 15% year to date, which is pretty outstanding for a portfolio of corporate bonds. Another thing you may have heard about within the last month or so has been the yield curve inversion. So I'll spend the next few minutes talking about what that is, what that means, why people pay attention to it, and if this can provide a useful signal for investors. So the yield curve inversion is basically comparing a short-term rate. This could be somewhere between the 3-month rate on treasuries or up to 2 years I've seen. And usually they're comparing that versus the 10-year treasury. When the 10-year rate yields less than the short-term rate, say the 3-month treasury yield, that's called an inversion. And it has inverted. Briefly it inverted in March, and now since May it's been pretty solidly inverted. Here's a chart, and there's a lot of lines, so I'll explain what we're seeing. This is basically just showing the inversion on comparing the 10-year treasury yield to the 1-year treasury yield. So I'm subtracting out the 1-year yield. Every time this black line falls below the 0% horizontal axis, that's an inversion. These vertical shaded bars show recessions, past recessions for the United States. And if you follow along, you can see that quite frequently when the line dips below 0 and signals an inversion, you generally have a recession fairly shortly after. It hasn't been perfect. You can go back to around 1966 or so, and you'll see there was sort of a false signal. There was, depending on how you measure this, there was sort of a false signal around 1998. And you can see where we are all the way to the right of the chart, where we are now at inverted territory. So this is why people are mentioning inverted yield curve inversion and perhaps being worried about it. It's widely regarded as a negative economic indicator, not just for the reasonable predictiveness, which I'll discuss more later. But also just it's a signal that people believe the Federal Reserve is going to be cutting rates, and they generally do that because they're trying to boost what they see as a weakening economic environment. If you think about it, what this is saying is that investors are willing to accept a lower rate of return by lending their money out, say 10 years, than they are on an investment that they're lending out for 2 years, which is kind of an unusual circumstance. You can imagine if a family member came to you for a loan and they wanted to borrow something for 10 years, you would probably want to charge them a higher interest rate than if they wanted to borrow for, say, 6 months. So how predictive has this been? And we saw in the previous chart, there does seem to be a relationship between the inversion and when a recession occurs. I mentioned there has been some false positives. So first of all, I'll just mention there's no real standard way that I've seen that inversion is measured. Typically, the 10-year is used for the long-term rate, but the short-term rate could be 3 months, 6 months, 1 year, 2 years. So there isn't really agreement on that, and that makes it hard to draw conclusions about how accurate this inversion is. So starting actually outside of the US, this inversion actually hasn't been a very great indicator. So one example is Australia. There's only been one recession since 1990, but the yield curve has inverted 4 times. So there's been 3 false positives in that time period. Turning to Japan, the yield curve has not been inverted since 1991, and yet they've experienced multiple recessions. So rather than false positives, there's false negatives where recessions occurred and the yield curve did not invert, so there's no warning sign. There was also a case in Germany in the last decade where you had a recession and there was no inversion related to the European debt crisis. I believe that was about 2014 or so. So going back now to the US markets, first of all, even if the signaling, the predictiveness of the inversion is pretty accurate, it won't tell us how long the recession takes to occur, how bad the recession will be, nor how long it will last. And as I mentioned before, depending on which rate you use on the short term and compare it to the 10-year, you get recessions that have occurred somewhere between 6 to 24 months after the inversion has occurred. So a 2-year time lag between recession and inversion is quite a long time. And so I'd also mention that the stock market itself is not synchronized with recession. The stock market tends to peak prior to recessions occurring and starts rallying from the bottom while the recession is still going on. So this disconnect makes it even harder to use yield curve inversion as a timing signal to get in or out of stocks. When I did my own personal little study and I said, okay, here's when the yield curve is inverted. Would this have been a useful timing signal on, say, looking at 6 months or 12 months in 6-month increments going out to 4 years? So I looked at a variety of different time periods. And on average, stocks had actually still been positive over these different increments, all of them, in fact. So that just lends credence to trying to use inversion as a timing tool. Just flat out doesn't work. Hasn't worked historically. In other countries, it hasn't been very predictive either. So just want to lay your fears to rest if you're thinking, oh, I read a newspaper article and there's yield curve inversion, that means the recession's coming, I better sell. My answer is no.
Thank you, Ryan. That was great information. On this next slide, comparing the 10-year Treasury to the 30-year mortgage rates, we wanted to include this to highlight the significance of the 10-year Treasury yield as it's used as a kind of foundational benchmark for interest rates on almost everything else, especially mortgages, but car loans, any kind of debt that you can think of. So this chart goes back to 2018. The bottom green line is the yield on the 10-year Treasury over this period of time, and the red line on top is the 30-year fixed mortgage rates. So as you can see, at the beginning of 2018, mortgages 30-year were started at 4% and increased up to 5%. At the same time, the 10-year Treasury yield was at about 2.5% to begin the time period, and it rose to, I believe it was 3.23% on November of 2018. Ryan referred to that just a few minutes ago. Now you can also see as we've gotten into 2019, the trend has been down. As we mentioned, the 10-year dipped below 2%, which is pretty stunning, and mortgage rates have come down below 4%. I saw a quote this morning at 3.73% for 30-year fixed mortgages. So that's good for economics. It's good for home buyers, home sellers, developers. It's a positive sign. For the next minute or so, I just want to run through some positive and negative forces that are driving the credit markets and the economic consequences. The European Central Bank has announced it's ready to cut interest rates and provide economic stimulus in Europe, in the Eurozone. Other things they can do is buy bonds on the open market, like the Federal Reserve did a while ago during the financial collapse to keep interest rates low. The question's been raised since we're looking at a slowdown in the US economy and certainly a global slowdown. Did the Fed make a mistake raising interest rates 4 times in 2018 as part of their 9-rate increase cycle? I don't criticize the Fed for what they did last year. I think it was appropriate. What they cannot continue to predict is what President Trump is going to do next or has done so far with his mercurial trade policies, which are definitely affecting economic growth here and abroad. The fact of the matter is that just as inflation looks to be lower for longer, so are interest rates. This was a phrase that came up after the financial collapse, and it's the Fed was raising rates starting in 2015. Now it looks like that cycle is over, and so we are looking at low interest rates and low inflation rates. The Federal Reserve just had finished its June meeting on the 19th, and Chairman Powell announced that the vote of the Federal Open Market Committee at this point was not to raise rates following its June meeting, but the probability of a rate cut in July is strong. And our view is that if Trump does not complete a meaningful and specific trade deal with China before the Fed's July meeting and inflation stays stubbornly low, a July rate cut is very likely. Certainly a negative point is that for our president, tariffs have become an all-purpose tool used to fix almost anything within sight. When Trump threatened tariffs against Mexico, which were withdrawn, he was using tariffs as a tool because of immigration challenges and as a means of putting pressure on Mexico to do more to help us solve the immigration problem. That's the first time in history tariffs have been used for a non-economic reason, and frankly, it's a bit scary. The Wall Street Journal has been a stalwart critic of Trump and his tariff and trade policies. The June 1 lead article in the Journal's opinion page was titled "Tariff Man Unchained." They did comment about the threats to Mexico, and if they hadn't been withdrawn, that would have violated the North American Trade Agreement and the World Trade Organization rules. The mercurial quality of President Trump's approach to trade and tariffs and threats and then backing off It's really lowered his credibility around the world. It's not a good result. And Republican Senator Chuck Grassley, a Republican from Iowa, he wrote an editorial this month openly opposing Trump on what he calls his Fortress America initiative. The trade war is definitely a headwind for an already weakening global economy. Trump's tariffs have been in sort of a scattershot, unpredictable pattern, and it's obviously now hurting employment as well as investment. That's from the Wall Street Journal again on June 8th. Much anticipated. I'm not sure if the plane has landed yet in Japan, but Trump was flying to Japan for the G20 summit with the 20 largest economies among nations in the world. There's a very important planned meeting with President Xi of China. And there's great hope in the marketplace that some kind of trade truce that's reliable and specific would delay a new round of tariffs that have been threatened by Trump if there's not progress. These new tariffs on $300,000 of government Chinese government goods would put tariffs on just about everything China produces. On the positive side, this brings us to our economic growth, our final section. The U.S. consumer has been strong. I just heard a report this morning that consumer confidence is weakening a bit. But despite the fact that the U.S. economy added only 75,000 jobs in May, the consumer was strong in that month. That's a good sign. Another positive note is that there is solid demand for U.S. corporate bonds. And this signals a level of optimism from a group that's generally very cautious as investors. So moving along, it's clear that U.S. economy is losing momentum. For March, April, May, the job growth averaged 164,000 per month. This is a drop down from last year where the average monthly growth rate was 223,000 a month. And in Obama's second term, his last 4 years, job growth averaged 217,000 a month. So statistically, what this means is that job creation has reached its lowest pace since 2010. An advisory group, Macroeconomic Advisors, forecasts that the GDP growth for the second quarter, which is just ending on Friday, will be at 1.4%, which is quite a drop down from 3.1% in Q1. So there's obviously a mix going on in terms of the economic signals. I'm going to turn this back to Ryan.
Thanks, Jim. I'll just briefly cover this slide. What we're seeing on the turquoise or bluish line is just the S&P 500 price. And so you can see it's certainly recovered since its fourth quarter of last year's slide and approaching new highs. But to me, the more important thing is the darker black line, which is earnings per share. And the reason that's important is just to show that the price of the S&P or the US stock market is still fairly connected to corporate earnings. So corporate earnings continue to increase. And it just shows there's no disconnect or prices increasing when the fundamentals might suggest that that's unjustified. So I just wanted to put that in here, and I figure it's an important point to make.
I agree, Ryan. Thank you. So this brings us to our last slide before we go through some conclusions. First point, global trade growth has slowed to its lowest rate since 2008 financial crisis. Last year, China posted its lowest growth rate in 28 years. We're listing these because we hope the White House will be hearing these wake-up calls that the trade wars and so forth are really having a negative impact. The U.S. Institute of Supply Management factory index dropped to its lowest reading since Trump became president. And my favorite professor in Germany from the University of Duisburg-Essen, I found an article and quote from him where he says, "We are experiencing the biggest decline of world auto market in 20 years. So some significant positives and negatives. And this brings us to our conclusions, and Ryan's going to start us off.
Thanks, Jim. So as we mentioned, global growth is still occurring, albeit at a slower pace. We feel like if there was not these tariff and trade war distractions going on, growth would be more robust. In response to some of this, central banks have been implementing monetary policy stimulus, such as the Federal Reserve and the European Central Bank considering it as well, to try to restore some of these growth rates to a higher level. You also have China implementing some fiscal stimulus as well to try to combat some slowing growth rates. And if those measures are successful, that could be a boost to stock markets. And I'd also point out, as my previous point, that bond allocations have been a friend to investors for a long period of time and continue to play an important role in many investors' portfolios.
Thanks, Ryan. To continue on, as Brian covered in great detail, the yield curve inversion has limited application to long-term investment strategies. The U.S. consumer has certainly remained relatively strong, and we'll see what might happen out of Trump's meeting with President Xi. Our view is that Trump is overconfident that he can continue his trade wars without harming U.S. workers and also being a threat to his 2020 re-election. Our final point is that we are big champions of financial planning at Bell Investment Advisors. We believe that every portfolio strategy should be guided from the goals and criteria and directions set by a personal financial plan. And we also have the practice of updating financial plans for our clients on a regular basis so that they have the reassurance about their plan, whether it's on course or off course, and what the remedies might be. It also helps our clients avoid the temptation of market timing. As Ryan mentioned, market timing is has a real negative impact on investors. And the most important focus of all, in our belief, is that investors need a financial plan, and they need to know where are they as the plan progresses and gets updated in terms of their goals. And we're big champions of that. We think nothing else matters. It's more important than what the S&P 500 is doing. Is, are you on track to live a good life as you define that? So thank you for joining us. We still would encourage you to submit any questions that you have. We'll make sure that we answer them offline as we draw to a close here. We will post this webinar on our website library in about a week. So you can look for it there if you want to go over it again or refer it to friends. As you can see, we have a robust library of our webinars on our website. Our next time to be with you will be in August for our next investment committee update covering the third quarter. And we don't have a date yet, and so we'll let you know when registration is available. Again, thank you for joining us. There's lots of ways to stay in touch with us, our website, our LinkedIn. We have 2 blogs on career and life coaching from Bonnie Bell, and we also have a finance blog Thank you for listening today. We look forward to meeting with you again in August, and we welcome you to contact us if you have any questions or concerns. Thanks, Ryan.
Thank you, Jim.